Sir, in the family, I'm a vampire. Sabidi. I know you're waiting around, just killing you. In my Panamera, hola, hola. I'm levitating, I feel like you see when you whisper that Panamera. It's in you put all this young love. Yeah, my heart and my soul alone. And I wanna go crazy with you. Today night, today song, but do it all, hola. We don't do any walk, I never wanna lose this. Feel I belong. This must be love. Oh, your life more, I don't know this. Say you wanna do what I say. What they got for me? Baby, contemplate. Say, oh, might be out for you. If I'm alive, you know that you have some time. You're on that way. Why you forget what you go for? If I'm alive, you know that you have some time. You're on that way. Jolly, body, I call police. Say, baby, sweet body, I don't police. Say, I don't feel to consider, oh, yeah. Jolly, body, I call police. Say, baby, sweet body, I don't police. Say I don't feel to consider, oh, yeah. See me, I can't let you go. So me, I can't let you know. You know me, I can't let you show. Find your leader, come play for you. And I don't feel way for you. I call you, say this love me get sweet for body. Look up your always my money. I want to see something, you carry something, you do me something, you keep me confidence. I don't feel complete. Well, I'm going to So we repeat it through the
Anybody should be from my friend. That's what my friend.
I was so many years in this kind. This one was a year. About the message in the corner, so many years in this. So on the phone, on the many years in this kind.
That's something like
Okay.
YouTube. My channel of the life.
Oh yeah, YouTube papa.
Guys, see what I was saying. Okay, I think this.
Maame na ɔka sɛ ɔba bɛtu ɔno nana yɛfrɛ sɛ Sylvester na Steven ɛhwɛ ne ntoro no kyerɛ no.
Sure. All right, guys. Tip one hits. Okay. Tip one hit already.
Sɛ nipa kyɛ kura wɔn.
This is something. Something.
Nanso mo delete apps no nyinaa fi me phone so.
When you first delete it, you delete it from app you now. That's when delete it from settings.
Ɛna boa ne
Why? And then make actual how they.
mekɔ settings wɔ no.
Cause setting work storage. Only with me and that's apps. Cause setting work apps and not storage. When okay, we always secure tip one. Tip one, so like we are still on it. Okay. So tip one already secured, and we are still on it. Let's see where it takes us.
Mepɛ sɛ ne update no. I'm so on online update no.
Complete, no, update.
But delete ne nyinaa.
Phone storage. What delete?
Hmm.
Phone storage and put it on.
Only if I'm becoming deleting active member, I want to deleting.
Videos when audio
Um,
to be on open what's in the time of the video. button.
So, yeah.
Everything you think you know about why the market moves. Seriously, forget all the patterns, the indicators, even the news headlines for a second. We're going to pull back the curtain and look at the actual engine that drives price. And I'm going to hand you the institutional blueprint for navigating it. Think of the market like a mountain trail. Now, most traders out there are what I call reactive hikers. They see a storm pop up like a sudden price spike and they just react. And they usually get soaked. But the pros, they're proactive. They read the signs, they anticipate where the market is really heading, and they adjust their route before the storm hits. See the difference? They aren't reacting to where price has been, they're positioning for where it's being engineered to go next. So, what is that weather pattern in the market? Well, it's not random, not at all. The market has an engine, and that engine runs on one very specific type of fuel. It's called liquidity. So, what is liquidity? In the simplest terms, it's just a big cluster of orders. And we're talking specifically about stop loss orders from retail traders. I mean, think about it. For an institution to buy or sell $1 billion worth of an asset, they can't just click a button like we do. They need a massive pool of people on the other side of their trade. And your stop loss? Yeah, that's the fuel they're hunting for. Okay, so this brings us to the most important question, right? If all this liquidity is just sitting there in obvious places, like above recent highs and below recent lows, then who is actually designing the price moves to go out and grab it? The answer to that, well, that's what separates the entire retail mindset from the institutional one. It's almost like there are two completely different games being played on the exact same field. You've got retail traders playing one game, and then you have institutions, or smart money, playing an entirely different one, with a playbook you probably haven't seen. And here's the difference in a nutshell. The retail mindset, it's all driven by fear and greed. It's focused on chasing patterns and buying breakouts. But smart money, they're driven by two things, liquidity and market structure. They execute using a specific model you might have heard of. Accumulation, where they quietly build a position. Then manipulation, where they engineer a price move to grab all that liquidity. And finally, distribution, where they sell their position to the crowd. Even their risk management is totally different. Retail traders put their stops in the most obvious spots, while institutions place theirs based on where the traps have already been sprung. Let me give you a classic example of a trap. Some big bullish news drops. The average retail trader, full of FOMO, jumps in and buys the breakout instantly. And where do they put their stop loss? Right below the recent low, of course. So what does smart money do? They wait. They actually push the price down just enough to trigger all those stop losses, sweep up that tasty liquidity, and then they enter their own long positions at a much better price, riding the wave that they just created. And that right there is the core idea. The market is not a friendly place. It's a predatory environment. Your goal isn't to follow the herd. It's to understand where the herd is being led so you can anticipate the trap before it happens. So, what do they actually focus on? This chart tells the whole story. A full 50%, half of their entire focus, is just on liquidity sweeps, finding and triggering those pools of stop orders. The other half is split between understanding the big picture market structure and, this is so important, timing their entries during very specific high volume windows. Okay, so we've covered the what and the why. Now let's get into the good part, the how. This is the actionable blueprint. This is the step-by-step process for actually aligning your own trading with what the institutions are doing. This is it. This is the plan that shifts you from being the hunted to understanding the hunt. All right, here we go, the blueprint. Step one, macro bias. First things first, you got to figure out the overall market direction based on fundamentals. Are we generally looking to buy or sell this thing? Step 2, identify liquidity zones. Go on your chart and mark the obvious levels, the previous day's high, the previous day's low, places where stop orders are definitely clustered. Step 3, await the sweep. Now you do the hardest thing in trading. You wait, patiently. You let the price come to one of your zones and take out that liquidity. Step 4, confirm the shift. This part's crucial. After the sweep happens, you need to see a clear market structure shift. That means a break of a recent high or low that signals the institutions have stepped in and taken control. Step 5, enter in a kill zone. Don't just trade whenever you feel like it. You execute only during the high volume London or New York sessions. That's when the big moves are engineered. Step 6, manage your risk. You place your stop loss strategically, way beyond the trap, not where everyone else just got taken out. And finally, step 7, you put it all together and you trade with precision, not with hope. Think of this as your final pre-flight checklist. Before you even think about clicking buy or sell, you have to run through these questions. Has liquidity actually been swept? Yes. Have I seen a clear structure shift? Yes. Am I trading inside a kill zone? Yes. And is my stop in a safe place beyond the trap? Yes. If you can't tick all 4 of those boxes with a confident yes, you simply don't take the trade. It's really that simple. So why is timing so critical? Why are we so obsessed with these kill zones? This chart explains it all. These zones work because that's when institutional volume is at its absolute peak. Trading during the London and New York sessions means you're swimming with the sharks. You're operating when the biggest players are making their moves. Try Asia, let's huddle. The big fish just aren't there. This blueprint is so much more than just a technical strategy. To really use it effectively, you need a fundamental shift in your entire mindset. It's about learning to see the market for what it really, truly is. And a huge part of that shift is how you look at the news. The typical retail trader believes that the news itself dictates the direction of the price. But the institutional view, it's way more sophisticated. For them, news is just the story. It's the catalyst they use to create the emotional spike they need, to engineer the liquidity hunt they were planning all along. This quote right here just sums it all up perfectly. The fundamentals, the news, that gives you the big picture bias, the overall tone of the market. But smart money uses that tone to set a very specific technical trap to get the liquidity they need. And your job is to understand both sides of that equation. So with this blueprint, the power really shifts back into your hands. The next time you look at a chart, don't just see lines and candles. See the story, see the traps, see the liquidity. And before you place your next trade, I want you to ask yourself one simple question. Are you on the side of the hunter setting the trap? Or are you about to become the fuel for their next move? All right, let's talk about one of the most maddening things in trading. We're going to take that moment where you get kicked out of a trade right before it moons, and we're going to turn that into your single best entry signal. Does this feel familiar? You've done the work, you've found the perfect setup, you place your trade, set your stop loss, you're feeling good, and then, bam! This insane wick comes out of nowhere, spikes down, snags your stop to the exact tick, and then immediately roars back up in the direction you knew it would go. It feels personal, right? Like someone's out to get you. Well, guess what? That feeling you have, it's spot on. It was not bad luck. It wasn't a random market flicker. That was a calculated move, and it's called a stop hunt. But here's the good news. Once you understand how this works, you can stop being the prey, and you can start trading right alongside the predators. So, first things first, let's dissect this trap. We have to understand the why behind these moves before we can learn how to flip it to our advantage. And look, this isn't because you're a bad trader, it's because you haven't been taught the rules to the real game that's being played. Okay, so what is a stop hunt? It's really just a liquidity grab. And liquidity, in the simplest terms, is just a big pool of buy and sell orders. Now think about it. If you're a huge institution, what they call smart money, and you need to buy a massive amount, you can't just click buy. You need to find a giant cluster of people willing to sell. And where's the most predictable place to find a ton of sell orders? Yep, right below those obvious support levels where everybody puts their stop losses. Their goal is brutally simple and super effective. They just nudge the price below that key level. What happens? It sets off a chain reaction, a waterfall of stop losses from retail traders like us. This shakes out all the nervous traders, but more importantly, it creates this huge surge of sell orders that they can then scoop up, giving them the perfect entry for the real move they wanted to make all along. And right here, this is the whole game. It's a total mindset shift. When a retail trader sees support break, what's the first instinct? Panic. Oh no, it's breaking down. I gotta sell. Get me out. But smart money, they think the exact opposite. They don't see weakness, they see a manufactured opportunity. All those people getting stopped out are handing them cheap inventory right before the price is about to rally. So here's how the trap is laid, step by step. First, they push the price just below a super obvious support level. Second, all those stop loss orders get hit, creating a flood of selling. Third, the smart money steps in and quietly absorbs all that selling, filling their giant bags. And finally, once all the sellers are flushed out, there's nowhere for the price to go but up, and it reverses hard, leaving everyone who sold at the bottom in the dust. That's the trap. Okay, enough about the problem. We get it. Now, let's build the playbook. Let's figure out how to turn their trap into our absolute best entry signal. It's time to flip the script. These are the exact signs you need to be looking for on your chart. First, it all starts with a support or resistance level that is just crystal clear. So obvious, you know thousands of other traders see it too. Then, you get that sudden, violent stab through the level. That's the hunt. But the real key is what happens next. A super strong, fast recovery back above the level. And often, you'll see a massive spike in volume on that recovery candle. That volume spike is your big tell. It's basically screaming that the big players just bought up everything. So here's your 4-step strategy, and the most important word here is patience. Step 1. You see that clean support level, but you do not buy there. You wait. You fully expect the trap. Step 2. You watch for that sharp wick to stab below the level and take out the stops. Step 3, and this is your green light, you only enter after the price aggressively reclaims that level and the candle closes back above it. And finally, step 4, your stop loss goes right below the low of that nasty wick. Your risk is now incredibly small. You see what we're doing here? The whole point is this massive psychological flip. The exact area on the chart where everyone else is panicking, where their stops are getting hit, where they're being forced to sell in a losing position, that becomes your precise point of entry. You're literally using their forced selling as your confirmation to buy. This is how you start to trade with the market's flow, instead of constantly fighting against it. Let's make this real with an example. Let's say there's a clear support at 95 cents. Everyone sees it. The hunt begins, and the price suddenly stabs down to 92 cents, triggering all those stops. But then it recovers fast. You don't enter at 95. You wait for the confirmation and enter at 96 after it's proven itself. Now your stop loss goes just below that wick at 91 cents. So what's the result? You're risking just 5 cents per share, but your potential target could be up at $1.05 or higher. That is a professional, high-reward, low-risk setup. You know, mastering this goes beyond just a technical strategy. It's really about developing a mindset. It takes patience to sit on your hands and wait for the trap to spring. It takes precision to act decisively on that reclaim. And it takes confidence to buy when everyone else is selling in a panic. So before you ever put a single dollar at risk, just run through this mental checklist. Number 1, is this level painfully obvious? If it is, expect it to be a target. 2, did we get that sharp liquidating wick below it? 3, was the reclaim back above the level strong and convincing? And did you see that big volume spike? And finally, do I know exactly where my entry, my stop, and my target are? If you can't check off all these boxes, just let the trade go. So, I want to leave you with this one core idea. Stop thinking like the rest of the crowd. Instead, start thinking about where the crowd is going to be forced to exit their trades. Stop putting your stop loss in the most obvious place. Instead, start looking at that zone as your potential entry. If you can learn to trade where others get stopped out, you're going to start seeing the market in a whole new and much more profitable way.
Welcome to The Explainer. Today we're diving deep into a chart pattern that honestly traps most new traders, equal highs. But by the end of this, you're going to see this pattern in a totally new light. Not as a trap, but as a massive trading opportunity once you understand what's really happening behind the curtain. So let's kick things off with a scenario that I bet feels painfully familiar. You spot this really clear resistance level, right? You do the safe thing, place your stop loss just above it. And then, bam! Price spikes up for a split second, takes you out of your trade, and then immediately reverses and goes exactly where you thought it would. It is so frustrating, but here's the thing. It
is not random. The reason you keep getting caught in that trap, it often comes down to this one specific pattern called equal highs. And trust me, once you get this, you can start turning that frustration into a profitable strategy. So, what are we talking about here? On a chart, it literally looks like a flat ceiling that price just can't seem to break through. Now, most traders see this and their brain screams, strong resistance. But what if I told you that ceiling isn't a barrier at all? It's actually a target. Okay, so spotting these things is actually pretty straightforward. First, you're just looking for two, maybe more, distinct peaks that hit roughly the same price. They don't have to be perfect to the penny, but they need to form a really obvious horizontal zone. And this is key. You have to see this pattern within the bigger story the market is telling. Context is everything. Now, let's get to the really juicy part. The reason why this pattern is so incredibly important. See, it's not about the resistance level you see. It's about what's hiding just above it. And this right here, this slide perfectly illustrates the two completely different mindsets in the market. On one side, you have the retail trader thinking, perfect, a safe place to hide my stop loss. But on the other side, the big institutions, the smart money, they're looking at that exact same level and seeing a giant, predictable cluster of orders, a pool of liquidity just waiting for them. So here's the crucial point. Every single time a trader places that safe stop loss just above those equal highs, they're actually helping to build a bigger and bigger target. It's this collective behavior, right? It's driven by all the same trading books and courses that makes the area a super predictable honeypot for anyone with enough capital to move the market. And this is that honeypot. A liquidity pool is exactly what big banks and hedge funds need to operate. You see, to fill their massive orders without sending the price haywire, they need a whole lot of people on the other side of their trade. And where can they find a huge number of guaranteed sellers? You guessed it, right where everyone has placed their stop loss orders. Okay, let's move on and actually watch how this hunt for liquidity plays out on the chart. This is where the trap is finally sprung. This aggressive move actually has a name. It's called a liquidity sweep, or sometimes a stop hunt. It's that sharp, sudden spike that looks like a breakout, but it's really a calculated maneuver designed to trigger all those orders that are just sitting there, right above the equal highs. It happens in 4 pretty predictable stages. First, the pattern forms, and that attracts all the stop losses. Then, the price intentionally gets pushed just past those highs. This triggers all the stops, which provides the liquidity for the big players to fill their orders. And finally, with their mission accomplished, the price reverses hard, leaving everyone else trapped. This is so important to remember. You do not want to be the one providing the liquidity. So instead of seeing equal highs as your signal to sell right away, you need to see them as a warning sign, a clue that a liquidity sweep might be on its way. Your job is to wait for the market to show its hand. All right, so now that you know how to spot the trap, let's talk about how to actually use this knowledge to your advantage. It's time to stop being the hunted and start trading right alongside the hunters. The number one rule here is patience. You absolutely have to wait for that sweep to happen first. Then you start looking for confirmation. Did a huge bearish candle just form right after that spike? Did price slam down and break a recent low, showing you the momentum has shifted? These are the clues that tell you the reversal is for real. Now, if you want to stack the odds even more in your favor, look for confluence. So if you can find a bearish order block hanging out near those equal highs, that's an incredibly powerful combination. A really high probability entry is when price sweeps the highs, reverses, and then pulls back to test that order block. Look, your biggest enemy when you're trading this setup isn't going to be the market. It's going to be your own brain. That fear of missing out, or FOMO, is going to tempt you to sell before the sweep happens. Impatience will make you jump in without waiting for any confirmation. And bias will make you try to short this pattern even when you're in a massive bull market. You've got to fight those urges. And when you do finally enter a trade, where should your stop loss go? Well, here's the golden rule. Place it above the highest point of the wick that did the sweep. That puts your stop safely outside that volatile zone and protects you from the very move you were waiting for. So, to pull all of this together, let's build a simple little pre-flight checklist that you can run through before you even think about placing a trade based on this idea. Okay, first box to check, market structure. Look at a higher time frame. Is the overall trend on your side? Second, liquidity sweep. Have you actually seen a clear sweep? Look for that long telltale wick. Third, reversal signal. Is there hard evidence? And finally, confluence. Is there anything else, like an order block, that strengthens your case? If you can tick these boxes, your odds just went way, way up. And that right there, that is the fundamental shift in perspective that changes everything. When you learn to see the market through the lens of liquidity, you stop seeing barriers and you start seeing targets. So the next time you spot that perfect price ceiling, just ask yourself that one simple question. It'll help you stay out of the traps and start finding much, much better trades. All right, let's get right into it. Today, when we're past just looking at big flashy candles and chasing them, we're going to learn how to actually read the story they're telling us, and more importantly, how to tell the difference between random market noise and a real institutional footprint. Come on, we've all been there, right? You see the price just taking off like a rocket. That FOMO, the fear of missing out, it just grabs you, your heart starts pounding, and you dive in, totally convinced this is the move that's going to make your month. And then, bam, the very instant you click that button, the market hits a brick wall and screams back in the other direction. You're left sitting there in a losing trade just thinking, what just happened? It is one of the most maddening things in trading. But here's the thing. What if that explosive move was never what it seemed to be in the first place? Okay, so this is where we get to the core idea. The big secret is to stop seeing all big moves as the same thing. We have to learn the difference between what most retail traders call momentum and what the big institutions are actually doing, something we call displacement. So first, let's talk about the trap. This is what almost everyone chases. It's just raw volatility. A sudden burst of energy that can pop up anywhere, often stuck right in the middle of a trading range. There's no real purpose or story behind it. It's just noise. Now, this is a totally different, not some random spike. It's a deliberate, calculated move by smart money to reprice the market. And it has a very clear signature. It always grabs liquidity first, it breaks key market levels, and it leaves behind a very specific clue, an imbalance. So if you're going to remember one thing, it's this. One of these is just chaos, and the other is a clear message. Retail momentum is just volatility. But institutional displacement, that's a statement of intent. It's a deliberate and powerful shift from one price level to another. And honestly, that's the entire game right there. It has nothing to do with how fast the candle is moving. It's all about asking why it's moving. Was there a purpose? Did it accomplish something significant on the chart? That's how we start treating the narrative, not just the price. And you can really see the difference when you put them side by side. Look, true displacement is so methodical. It always begins by taking liquidity. It's basically grabbing pools of stop-loss orders to fuel up for the real move. And the candles themselves tell you everything. You'll see these big, full bodies showing real commitment versus those spiky, long wicks you get during a news event, which is just pure chaos. Okay, so we know what to look for, but how do we spot it happening in real time? Well, there's a blueprint for it. A repeatable 4-stage sequence that these high-quality moves follow almost every single time. Here's the sequence. First, price goes on a hunt for fuel. That's the liquidity grab. Second, you get that aggressive displacement move that breaks market structure. Third, and this is the absolute key, price pulls back to rebalance the inefficiency it just created. And finally, step 4, that retracement gives us our high probability entry point. I really want you to burn this into your mind because it's maybe the most important rule here. If you chase that big explosive candle in step 2, you are the liquidity. You're the one funding the move. The professional way is to sit back, stay patient, and wait for the pullback in step 3. The big move shows you their hand. The retracement is your invitation to join them. So where exactly are we looking to get in during that retracement? Well, this leads us to one of the most powerful tools for trading this whole idea, the fair value gap. See, when price moves with that much force, it literally leaves a gap in the market, an area of inefficiency. We call that a fair value gap, or FVG. Think of it as a footprint left behind by the institutions. And the reason it's so powerful is that markets hate a vacuum. An FVG is a one-sided pocket of price, and the market has this natural urge to go back and rebalance it, to make it efficient again. That's our window of opportunity. But look, not all of these gaps are worth trading. You only want the A+ setups, right? So run every single one through this checklist. Did it form right after a major liquidity grab? Is this happening during the London or New York session? And most importantly, does it line up with the bigger story on the higher time frames? This little checklist is your quality filter. Context is absolutely everything in trading. Where the displacement happens totally changes its meaning. If it happens after taking out a major high or low on the outside of a range, that often signals a huge reversal. But if it happens inside an existing range, it's more likely just a sign that the current trend is going to continue. And this brings us to the final and most critical pieces of the puzzle, putting it all together with the right timing and, of course, managing your risk like a pro. Remember that checklist? Well, session timing is a huge validator. A big, aggressive move in the middle of a low volume session is, well, it's pretty suspicious. But that same move during the London or New York kill zones, when all the institutional volume is flooding in, that's a move you can trust. Timing is like a final seal of approval. And finally, your stop loss. Please stop placing it based on a random number of hits. Your stop needs to be logical. You place it at the exact point on the chart where the story you're trading is proven wrong. For a long trade, that's usually just below the low of the pullback. That way, you're letting the market structure, not your emotions, tell you when it's time to get out. So, after all that, what's the one single idea you need to walk away with? Let's bring it all home. And this right here says it all perfectly. The amateur trader chases the explosion and becomes the fuel for the institutions. The professional understands the whole sequence, waits patiently for that confirmation on the pullback, and begins to ride along with the smart money. Patience is your ultimate edge. That's the question. That's what you need to ask yourself from now on. Stop being a spectator who gets caught up in chaos. Start being an analyst who can actually read the story behind the price. I promise you, that one shift in perspective will make all the difference. Thanks for joining me.
All right, if you're a senior leader managing any kind of institutional risk, you know the foreign exchange market is completely transformed. It's now a high-speed, automated world. And understanding how all this algorithmic trading works, especially when things get stressful, isn't just a good idea anymore, it's absolutely critical. So today, we're going to give you a
Good
really
day.
the new reality.
Of
So,
trading.
here's our game plan. First, we're going to quickly trace how we got here, from human trading
So far,
pits
whilst
to
you're
today's
losing, you're
digital platforms.
gaining. As you
Then,
see the
we'll
numbers
crack
here,
open the algo playbook
let me
and
just
see
show
the main
this off.
strategies they're using.
Whilst
After
we're
that, we'll show
losing,
you
we
how
are
to read the
gaining.
digital footprint these algos leave behind.
And this trade we
Then,
literally
we'll
sent
put
in
all
the
that to the
Telegram group.
test with a massive real-world crisis. And finally, we'll zero in on the biggest risk this all creates, the terrifying idea of vanishing liquidity. You know, to really get a handle on the risks we're facing today, we first need to appreciate just how seismic the shift in the FX market has been. I mean, the era of traders shouting in pits, that's ancient history. It's been completely replaced by the silent, lightning-fast execution of machines. I mean, just look at how fast the machines took over. It started with banks in the 90s, then went totally mainstream in the 2000s when algos started making their own calls. But look at that last number. By 2019, we're talking about 70 to 80% of spot trading on major platforms being automated. Let that sink in for a second. This isn't some emerging trend. This is the market now. Okay, so if machines are running the show, what are they actually doing? It might seem like this impossibly complex black box, but honestly, most of these programs are running one of two fundamental playbooks, each one with a very different goal. And here's the fundamental split you need to understand. On one side, you have trading algorithms. Think of these as the hunters, the predators. They're designed to find profit, whether it's by making markets, chasing a trend, or spotting tiny price gaps. But on the other side, you've got execution algorithms. These are more like shepherds. Their job is completely different. It's all about safely guiding a huge pre-planned order into the market without causing a stampede. And this is where it gets incredibly relevant for you, for any institutional investor. Let's say a pension fund has to buy, I don't know, $1 billion worth of yen. The second they start doing that, the market can see it. And that very action can push the price up against them before they're even done buying. It's called market impact, and it can seriously eat into your returns. And this is exactly where those execution algorithms come in. They're basically a sophisticated shield against that market impact. They take that massive order, chop it up into thousands of tiny, harmless-looking pieces, and then slowly feed them into the market. It's like camouflage. It hides the true size of what you're doing to protect the price you get. For a big fund, this isn't just a neat trick, it's essential. So, since these algos are operating in milliseconds and their code is top secret, we can't just look under the hood. But what we can do is measure their activity through their digital footprints. The Bank of Japan came up with two brilliant ways to do this, and it basically acts like a dashboard for what the machines are up to.
The first dial on our dashboard is called fast-paced orders. All this really measures is the activity of the market makers, the folks who are constantly putting buy and sell prices out there. When this number is high, it means there are tons of quotes available. Think of it as a measure of how deep and liquid the market is at any given second. Now, the second indicator, fast executions, measures the other side of that transaction. It tracks how quickly those quotes are being snapped up or hit by the price takers. Like hedge funds using those directional trend following algorithms. This is our gauge for how much of that available liquidity is actually being used. And what do these indicators show us? Well, they reveal that this super high speed activity isn't spread out evenly. This chart here shows that even though overall trading in USD/JPY is huge during Japanese hours, the really intense algorithm-driven liquidity is almost twice as active during European and US market hours. That's where the most aggressive algos are playing. So, if you're a risk manager, here's your dashboard. High, fast-paced orders, that's a green light. The market is deep and healthy. High, fast executions, okay, yellow light, things are heating up. But a sudden sharp drop in fast-paced orders, that is the big red siren. That's the signal that the liquidity providers are pulling back and the market is getting fragile fast. Okay, so now let's take this framework and apply it to a massive real-world stress test. The incredible volatility that hit the markets in March of 2020 with the start of the COVID-19 pandemic. This was the ultimate test of how these automated systems would really hold up under extreme pressure. And at first glance, the results were actually pretty reassuring. As that first wave of chaos hit in early 2020, the data showed that on average, the algos held their ground. They kept the quotes coming and the market kept functioning. It really seemed like the system was working just like it was supposed to. This chart tells that story perfectly. Just focus on that green line up top. That's our fast-paced orders, our measure of liquidity. You can see that even as volatility started to spike, that line, on average, stayed pretty much in its normal range. So from 30,000 feet, it looked like the machines were handling the stress just fine. But here's the thing about averages. They can hide some really serious danger. The real question for any risk manager isn't how a system works during just high volatility, but how it behaves in those moments of extreme acute stress, when the market truly breaks. And here it is, the smoking gun. Look at the chart on the left. That's the flash crash on March 9th. Now look at the table on the right. See that number for fast-paced orders with the little asterisks? That number is the proof. At the exact moment of the crash, our liquidity indicator didn't just dip, it completely fell off a cliff. The drop was statistically significant. The machines didn't just make prices wider, they were turned off. The liquidity, it just vanished. This whole idea of vanishing liquidity is honestly the single greatest systemic risk in today's automated FX market. So let's really distill what this means for you as an institutional investor. Well, it shows us a critical fracture in the market. Not all liquidity is the same. Under stress, think of the big bank market makers as being able to bend. They'll keep quoting, but they'll make those prices painfully wide to protect themselves. But the non-bank high-frequency traders, they're programmed to break. Their algorithms have hardwired circuit breakers. Once volatility hits some preset kill switch level, they don't bend. They're just gone. And this isn't random. This behavior is driven by two huge fears. First, there's inventory risk. Getting stuck holding a position they can't get rid of as the market screams against them. And second, there's FX risk. The simple fact that the inventory they're holding is losing value by the millisecond. To defend against that, an algorithm only has two moves. Make trading ridiculously expensive by widening the spread, or just pull the plug entirely. In a flash crash, they choose to pull the plug. This quote from the Bank of Japan's own report just sums up this dangerous duality perfectly. In normal times, even in sort of stressful times, algo trading is great for market liquidity, but it has a breaking point. And during those moments of severe stress, that entire function can just be switched off, right when you need it the most. Which leaves us with the one critical question every single institutional leader has to take into their risk models now. Your trading strategies, your hedging programs, they're all designed for a liquid market. But in this new automated world, you absolutely have to ask, when the next severe shock hits, will that liquidity be there at all? All right, let's talk about one of the most powerful and frankly coolest concepts in trading, fair value gaps. Today we're going to crack the code on these things. We'll figure out how to spot them, why they even show up on our charts, and most importantly, how to trade them like a pro. Ready? Let's dive in.
You've probably seen this, right? These big empty spaces on a chart that just feel unfinished. Well, they're not random glitches. Think of them as footprints left behind by the market's biggest players. We're talking giant banks and hedge funds. If you can learn to spot these footprints, you're not just looking at a chart anymore. You're actually reading a story about where the smart money is planning to take the market. And by the end of this, you'll know exactly how to read that story. So here's our game plan. First, we'll cover what these gaps actually are. The market's glitch. Then we'll After that, we'll open up the smart money playbook to see why they form. We'll also cover how to avoid the common traps they set. And then, the best part, we'll build you a concrete trading plan and even look at how to handle these things during crazy news events. Okay, let's get right down to it. What in the world is this market glitch we call a fair value gap, or FVG for short? Think of it like this. The market just moved so fast and so aggressively in one direction that it literally skipped over some price levels. It left behind what you could call unfinished business. This creates a serious imbalance. The market absolutely hates imbalances. It feels this gravitational pull to go back and fill in that missing puzzle piece. And that's our opportunity. That's what we trade. Now, these gaps basically come in two flavors, bullish and bearish. A bullish FVG happens during a huge, fast move up. It screens intense buying pressure, and that area often becomes a future support level. On the flip side, a bearish FVG forms in a sharp drop, showing massive selling pressure, and it usually acts as a future resistance level. Knowing which one you're looking at is, well, pretty crucial for knowing which way to trade. Okay, so we know what they are, but how do we actually find these footprints on a live chart? It's actually more precise than you might think. It all boils down to the super simple three-pill pattern you see right here. Candle number 1, the move star of the show, the momentum. This is the big, powerful candle that actually creates the gap. And finally, number 3, the confirmation candle, proves the gap is real by not immediately filling it back in. When you see these three lined up, boom, you found the signature of a fair value gap. But hold on, not all gaps are created equal. You have to validate them. Look for a clean structure. Is the gap a decent size? A tiny little sliver might not have much juice. But here's the most important question. Does it align with the bigger picture? A bullish FVG popping up right on a major support level? That's an A+ setup. One that appears in the middle of nowhere? Not so much. We're hunting for these high. For a complete and more episode about the marketing, click the links.
All right, let's get right into it. Today, we're going to break down a really powerful concept and price action that's all about understanding pure, unadulterated market momentum. We're talking about breakaway gaps. You know the feeling, right? We've all been there. You saw this perfect-looking fair value gap on the chart. You get ready, you're patiently waiting for price to come back, tap into it, and give you that picture-perfect entry, and then it just doesn't. Price just keeps moving in one direction, leaving you on the sidelines. Super frustrating. Well, there's a name for that. That's a breakaway gap. And when you see one, it's one of the loudest signals the market can possibly send. It's basically shouting that it's picked a direction and it has zero plans of looking back. So let's log in a clear definition. A breakaway gap is, at its heart, a simple fair value gap, an FVG. But here's the key. Price never comes back to it. It leaves it totally unmitigated, which is just trader speak for unfilled. Now, this isn't some random accident on the chart. It's a deliberate message from the market showing intense, one-sided momentum. Okay, so seeing these after the fact is a real trick. The real skill is learning how to solve them in real time as they're actually forming. To do that, we need to be on the lookout for 3 very specific clues that tell us, hey, this isn't just any FVG, this is something much stronger. And here are our tools for the job, our confirmation toolkit. So after a fair value gap forms, you're going to be watching like a hawk for one of these 3 things to show up after it. A breaker block, an inversion FVG, or a balanced price range. When you see one of these form, that's your confirmation. That's what tells you the market is serious, and that what you're looking at is a real breakaway gap. Let's walk through the bullish version. So first, you get a bullish FVG. Simple enough. But then, price doesn't pull back. Instead, it pushes even higher and creates a new level of support, a new floor ahead of that original gap. Now, this floor will be one of our 3 tools. Maybe it's a breaker block, or maybe price just lost a small FVG, flipping it into support. That's an inversion FVG. Whatever it is, that new support level acts like a guard, preventing price from ever getting back to that first FPG. And just like that, it's locked in as a breakaway gap. Now, visually, it's really straightforward. A bullish gap is just a clear space left behind by a powerful upward, signaling heavy buying. A bearish gap is the opposite, a void created by a big downgrade, signaling heavy selling. That visible empty space on your chart, that's your first clue that one side of the market is completely in control. Now, for a bearish move, you just flip everything we just said on its head. A bearish FPG forms. Price then dives lower and puts in a new ceiling, a new level of resistance ahead of the gap. And again, this new ceiling is going to be one of our 3 confirmation tools. It's what blocks the price from ever rallying back up to fill that initial gap. So we know what they are, we know what they look like. Now for the $1 million question. What do we actually do with this information? And just as important, what do we not do? This is all about strategy. This is it. This is the first question every single trader asks. You see this explosive move. You see that gap just sitting there. Thanks. Perfect. I'll just set my entry order right there and wait for the pullback. And the answer is a hard, unequivocal no. This is maybe the most important rule of all. The entire point, the very definition of a breakaway gap, is that price leaves it behind. Trying to enter there is literally like leaving at the station for a train that has already left and is now miles down the track. It's not coming back for you. So you have to make a mental shift. You have to stop seeing it as a place to enter a trade. A breakaway gap is not a setup, it's a signal. It's the market giving you a massive piece of intel about where it's headed next. So what is it signaling? Well, it's screaming that there is incredibly strong one-sided momentum. It's telling you there's a very high chance the trend is going to keep going. And maybe most importantly, it acts as a filter. It tells you to immediately stop looking for trades against the trend. Trying to fight that kind of momentum is one of the fastest ways to lose money. Okay, let's pull all of this together into a really simple, practical checklist you can use when you're watching the charts unfold live. Here we go. Step 1, has a new FPG just formed? Check. Step 2, did price continue to move aggressively away from it? Check. And step 3, this is the clincher. Did price then create a breaker block, an inversion FPG, or a balanced price range just ahead of that gap? If you can say yes to all of those, then congratulations. You've almost certainly spotted a breakaway gap. And let me be perfectly clear about the biggest mistake you can make here. Do not chase the price. And for the love of your account, do not try to fade it. Chasing it means you're buying high and selling low. And fading it, that's like trying to stop a freight train with your bare hands.
I am afraid
The
my
whole
big
point of this
sister.
signal
I'm
is to
assuming
keep
I'm a big
out
sister,
hysterical
Babu.
trades. Now, of course, nothing in the market is ever 100% guaranteed. If, for some weird reason, price does come all the way back and closes inside that breakaway gap, the signal's off. It's invalidated. But here's the bigger picture on risk. Using this pattern correctly is a powerful form of risk management in itself. Because sometimes the best trade you can make is the bad trade you don't take. So I'll leave you with this to think about. Now that you can spot these huge signals of momentum, now that you know how to use them to filter out bad ideas, how does that change your approach? It should shift your focus away from the gap itself and toward finding a smarter, higher further down the road in the direction of that powerful trend.
Sister goes money now, baby.
It's all Todd. It's Premier League. It's La Liga.
It's
Hakimi. It's all the football you need. It's all Todd.
Yeah, but me go yell away.
I believe a lot in security. Sending money home, use LearnFi in sending money. Anytime you use LearnFi to send money, you get rewards. And there is this security to use. Send money now. Download the LearnFi app. The first time that you make your transaction,
Yeah, boy.
in Canada, you send $100 Canadian, you get $20 for free. If you're in USA and you send $100 US, you get $20 US for free. And if you're UK and you send £100,
About to
you
make
get
a jolly baby.
£10 cash back. Use my promo code EMELIA for good.
Yeah, a million. A million.
Use
No.
LeFi. LeFi, your money is
About 12 because yeah.
Send money directly into your bank account and then through mobile money.
Aye.
LeFi, we've got you covered. Use LeFi always.
Because yeah, right. So come here. Now come here then. Martin. You, Martin. Miss Martin, you hear you. Miss Martin. Commander in charge. Oh, Commander sister. Hey. Yo, Martin. Martin. Never mind. I'll go. Allah. And I'll follow back as a ready. Now follow back as a ready. Asa, ya kwa no engine na home. Because ya never me ba na sama. Me we are my friend why.
Someone kasa kakra sana kamodo mama. Madam, tia maji ya me. Ana praise so me no say, me ati no person no. Enye mu na mabafi ha bi, be me bia wo mo nchenta. Na sabi me ma susu ba na ye bi so ba nyina ba na fie. Na na me ka ma na gosi bi se so mada. Se no ma mu se mu ye pinini, no ma timi akọ mo so mo no go beti. Yeah, I'm for one see you and writing. Oh, well, if you have no motive, my father said, my man will set the friend would be like that. Says something like the mamma, I about ourselves in 10 years. Say, we are more food here. Which me power. Oh, she don't know any beer. You're funny. And then I had a beer. I see you. Turn to secret.
So he said, "You can work." Oh, he was also helpful somewhere.
Oh,
almost super.
Oh, what can happen? Good. Oh, me no want to be here so many years. I feel like open up one of the my idea. And I'm so many minutes when you're going to. It's a sound almost say, I'm Mrs. Sa. What by ya? Man, I said yes, and say yes, I have to date enough food, and I'm going to say enough.
pizza and the fried rice na. And any would drink it. Oh, wait a second for one. Oh, so for me, baby, auntie.
And you just leave your door locked like
I
that.
actually remember Cecilia, never buy, not getting educated.
But something no one said, oh, yeah, poor, but you fast.
Oh, me mammy, never from me. I say, I'm not the go see how Miss Cassam and Betty here.
Oh, you're okay.
Oh, you're very okay.
Are you sure you're talking to your mom?
Yeah, I was talking to my mother.
Can I see it?
Are you serious?
Yes.
Baby, let's just say, won't trust me. Maybe mammy and from me, I'm in the Cassam, won't trust me. Maybe for the mount, it would get tea. Some of the phone mount. Now, we shall say, mammy, 5,000 magic.
Yes, I'll give it to you.
Then you are serious.
I mean,
That means you don't trust me.
No, it's not like that. Even the good book says that we shouldn't trust any man. I don't want to say, didn't recover, have a call now. We just down to me, some down. What kind of I can't tell.
May met you 2 or 20. Me sing all the 5,000. I'm power the 5,000. Just want to make the phone number one share and say, me know, yeah, like I
Listen, it's all because
what I
feel for you and how I care about you. Maybe so be able to say in terms of like already know when I go home, I'm fine. But I don't want anything to happen, So you have to understand me.
Baby. So you're not me show me come a picture because me maintain I see I didn't mean panic them all relationship or bad stress. Mr. Minimum Mamma like assassin and minimum Mamma like assassin is that I'm power show go to 85,000 mammy. That means you don't trust me, you just gonna call me.
It's a full of man.
Mr. Minimum Mamma like assassin. Oh, 7 maybe after me that.
Let's help
What is he care to? Me show crunch.
Like how? That's it. I don't question my family and the person I'm 5 times to get for me. Anything coming to Canada. So why? No, what? Else? One of all, I was going to do power. That's it. it's a young one with you. Oh, after.
That was a new one.
Right. That was all too.
This is coming.
Oh, bro. Well, we're through.
Yeah, that's a new sin. The best how many years already? Why I got cracked? What you say?
Was it the say you
Yeah, me no more. So I got why. Like this is what I'm What's your why no?
We got something in break. So we join in at Japan when the first
know there are some flowers, so you know.
When I always know.
But seriously, what's it?
Open. Open everyone. Where?
Who is so you know? Because I know. I didn't got no one.
Where's that? Whenever you say,
Because a comedy discuss and I'm
that's
not.
not ocean. Kenya, and then my ever surprise you.
Kenya.
I get one, we see it again now. So what a friend of one. So better for one. And my first surprise. Who surprising an address? Aha. First, no idea more friend eating at it. And then just how. Now, search woman was searching yet. Sanity. It will be send your market to be very key. Onga pay, not the convoy children. That you did children, yes, sir. That's doing tomatoes in the idea of the young pine. No, you do bag, you know, man, bag, you cook a year. Laptop, and let go, it's a game boy. We have best, but we don't best land. Oh, I know. Near yeah, I know one, and when you say, the beauty catch him. And he I look at what you yes. Well, this and that because who if you got them here. Oh, I've been a new let's guy always say, what a yard, that's something could touch on the video. Still away. Oh, but you have a casa. You know, because.
Join us.
Against an empire. When trouble follows you, you have no choice.
Carrier charger is connected.
Nika, she said, "Yo, come, man, I got something to take."
I wonder what prime here.
Sorry. Nothing.
I'm not praying now. I pray too much. That's it. That's what I'm about to.
Say it.
link below the link found in the description of this video.
But I didn't come my own in my phone. I thought you, but I've at the time I'm not going to look. Yeah, I'm a new paper too. I will check it. I don't know what check up on. Well, I buy out check it. I'll check it. I have a check up on.
Why did you leave the work down there? I've been looking for you. Stand up, let's go. Stand up. Please, nobody should eat this food. It's a ghost. Nobody should eat this food. It's poisonous. Can you see me for that? No, just for that, but there is this student code that normally comes to my shop weeks. Very food though happening in the recent times. Imagine the economy now. Eh? You need a growth and becoming yourself. Honestly, my sister, that person is not good. You need to have not heard. No, just. They have been coming to my shop. That is the food. I just came out of my shop one day and saw the brand. You needed to see the way they tried this thing. They were they are not good. What do you want to say? Are you serious? You need to have not heard. Marco! You are not good. You have been using your friend. What? You see that goes normally come here. You see that goes normally come here now. So I don't want that goes in my shop again. Anything that guy comes here again, make sure you hold him tight. You cannot please warm me. No, madam, I will let me not die. It is that you are there for yourself. Look at you are looking at. My friend says that it's your partner, it's a normal partner. Don't allow me to forget my head on your head. Don't allow me to get it. If that guy comes again, make sure you hold that guy tight. You know how your wound is to be. Hold that guy tight. If you give that boy my food, then what I'm going to do when you not like me? Uncle Gabriel, how are you? Hey, Manuela was celebrating. You're a big girl now. Uncle Man, how is it?
Principal, that's not why we came here.
Okay, I was just about to before. We should have been here before now. We were waiting for him another 6 months. So that all of us can come here together.
Principal, my mathematics teacher gave me mathematics 7 and I got it right and she marked me back.
Yes, see, I don't know why I'm coming back to this. But this is the problem. If people don't want to believe this girl, I'm going to tell them
I don't know why every time she gets up to like,
yeah, I don't know what kind of person you're implying in this call. Just correct this out. If I don't believe, let me decide. See, principal, if the teacher don't know something, let the student teach the teacher, eh? And every time the teacher will be doing like this, doing like this, doing like this. And that's what I apply. Just
it's okay, that's fine.
let's see your here. What's up here? Eh? You gave her a mathematics question to somebody else. Of course, she's not correct. Yes, you feel that. Wow. Why you put it like this?
Yes, I did not she feels that's why hey! Some people are still like on my head. What I know is that all I have must go to hell. Yes.
I agree, sir. What was the question? Sure. No one happened now. We all. Just now, something that we lost now. Oh.
That's for now.
I went to come with one of that teacher. Let's go down.
many centimeters? What am I sir, how would you do I did not look for my
Success. What was your answer?
3 centimeters. Sir, the answer is just 3 centimeters. 600 Hey! Alaye, 600 centimeters in this mosque. Now this mosque is contain 600 centimeters. But sir, the answer is 600 centimeters. That is the lie. The answer is 6 centimeters.
Come down, everybody. Since we don't seem to agree here, you know, we can always disagree. Right? So, let's see.
If I can show what I can prove.
That's better. Take the matter. Go and show me.
Please, my people, what
Centimeter.
good? How many?
Why?
Good. Just follow me closely.
Online English courses. Online English courses.
My people, how many centimeters are here? Please count.
1, 2, 3, 4, 5, 6.
How many centimeters?
Centimeters.
Good. Cross multiplication now. Follow me. 60 times 2 60 times 2 60 times 2 What is remaining? Please. How many meters are here? Please count.
1, 2, 3, 4, 5, 6.
How many centimeters? Good. Please, how many centimeters did I use to achieve this result?
6 centimeters.
Good. Therefore,
Hello, everyone.
Wow. Fantastic. Awesome. Wonderful. My dear Friday. Wow. I like it. How many centimeters? 600. And China is moving on the board. Can't you see the hand of the wall? Can't you see the hand of the wall?
okay, success. Forget hard. What I meant was, how many centimeters makes 6? And me, I'm not forgetting you. You have put it easy, you have put it. So give me my mark. Yes.
I agree. Back.
And it's the next time you want to put it in, speak it, then at